Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Hello, and welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments in your retirement here on the Max Out Savings Show. Our show is all about building up wealth, understanding the world today, dealing with retirement, and navigating through these tough and difficult times. We have the show really to help you save money, build up wealth, increase your savings, and really we try to get you a different picture of what's happening in the world from the mainstream media. We'll give you our take on it without the spin, and so you can understand the world today. And as our motto and philosophy is to save aggressively and invest conservatively. That's the key to building up wealth over the long term. Save aggressively and then invest conservatively. And that starts with your 401k plan. You put away as much money as you can on this, and then you can just conservatively invest it. You're going to get a tax deduction right away. You're going to get tax-free growth over time. Huge. Tax-free growth is just an incredible thing. I can't tell you the difference it makes over time. As we've talked about in the show numerous times, Warren Buffett, one of the greatest investors, if not the greatest of all time, when he started out, one of the first things he did was buy an insurance company because he knew he could use the tax savings, the tax-free growth inside of it to build up wealth. And the government gives you that for free, so take advantage of it. At Max Out Savings Advisors, we manage retirement money, trust. After people retire, they come to us. They have an old 401k, they bring it to us. We don't manage 401k plans. Well, sometimes if someone asks a question, we'll answer it for them on it. But that's not our business. But this is so important to building up wealth and changing your life that we always want to talk about it. So, take charge of your life. Start your savings program today. Minimum of 10% plus the company match. And don't be a victim of the government or other things. Take charge of it and turn your life around. Another show. We're dealing with the war. How do we navigate that? We're dealing with the credit crisis. And the good news is I looked at the news today, and so far there hasn't been any stories on the credit crisis. I mean, it's just when I say credit crisis, private credit. And again, I want to build up on this a little bit because I think it's kind of going underneath the surface on things. And I've talked to some people. It's kind of it's not that complicated, but for some reason I think I'm real good at dealing with very complicated issues. I'm not being real clear on this, but the private debt crisis is private debt. It is typically debt made that doesn't trade on the markets. That's made to typically smaller corporations, private corporations. And oftentimes this used to be kind of the bank area. The bank would lend money, but what's happened is hedge funds and private equity groups and private debt groups have gotten in it. They've raised money and they're lending it out, and they take a percentage of the profits, and they're very aggressive. So they've taken a lot of business from the banks. They've taken a lot of business from the junk bonds that trade because they're willing to be much more aggressive, give you a lower interest rate. They don't ask for different terms in the loans to make sure that they're paid back and in covenants, and they're much less stringent. Well, these guys have been operating. They've been lending money to people, buying companies. If you want to do a leveraged buyout, you go to these people. Or if you want to take a company private, or if you just got out of MBA school and you want to go start your own fund, if you're trying to set up a private equity company, you talk to these people about maybe borrowing money to sit there and take the company private, and they've been blowing and going. It's a couple $1 trillion market. So private debt is they lend to the private equity companies or to private companies in general. And that's where the problem is, because you got a whole bunch of new people in the business. Someone told me there was more private equity companies than there are McDonald's out there. I couldn't confirm that, but I did confirm there's just thousands and thousands of these things out there. And then what they did is they sold, since it was private debt, they were getting a higher interest. So they sold it to individuals and said, look, since it doesn't trade publicly, you have to stay in. You get out on a quarterly basis. If you want to get out, you can get out on a quarterly basis. And they go, okay, well, this sounds okay. And candidly, if you have reasonable amount of money, you should be able to make investments where you're just going to hold them for years through the ups and downs. But that's another story we'll get to one of these days. But the problem is they said, well, look, we're going to set a limit. Only 5% of the money can come out each quarter. Well, that works fine when no one's real interested. And if somebody needs something for an emergency, they put in and they get their money back 100%. But all of a sudden, private equity starts going down. People are concerned about it. Everybody wants out at the same time, and they're doing what's called gating the funds, which means they're not letting everybody out. So all these funds now have to say, even if the gate is just 5%, they've got to sell 5% of their fund, which means they can't make new loans, which makes their other loans, which means the rates go up, which makes the value of their existing loans go down, and it's a real problem. And so is it going to be like great financial crisis of 2008? I don't think so, because the banks have pretty conservative balance sheets. But are there going to be money lost? Yeah, probably a lot of money. Could some people get in trouble and fail? Yes, we've already seen MSF in London fail. That was because they were cross collateralizing their assets, and that was about a $1.8 billion fund that collapsed. And you're going to see more of this. But what it's doing is it's tightening credit across the cycle. So if you're at a bank or another fund or something, you're going, hey, what's going on over there with credit? And you're like, well, I don't know. Our guys have looked into it. There seems to be real problems over there. What are you going to say? You're going to go, well, guys, we need to watch our lending real closely. We're not sure which way this is going to go. So they tighten their standards up at the bank, which means the bank, instead of giving you $1 million, will give you just $900,000 to borrow. And so it kind of cascades through the system. Credit crisis is like this, and it is a credit crisis. We don't know how much they take time to work out. In 2000, and you can see this happening. We titled in the Max Out Savings Report, I want to say in July, maybe August of 2007, we sent out a report titled "The Perfect Storm with Credit in the Mortgage Market." Because housing prices were starting to fall, there was huge amount of lending. Lending was out of control, similar to private equity. And then in November of 2007, late November of 2007, I believe, we wrote out a report that we basically laid out the case that a major Wall Street bank was going to fail, and we put in our free Max Out Savings report we sent out. We put in a very simplified versions of the balance sheets for people to kind of see what we were talking about. We'll say, look, these firms, we thought it was going to be Lehman Brothers. It was actually Bear first, then Lehman Brothers failed. We said they're growing their assets at about a 35% rate over the last 9 months, that you cannot bring in money and vet these loans, and they're bringing a lot of bad loans, and they're going to lose their funding on the other side. When people see these are bad, they're going to cut the Wall Street firms off from their credit, and they're going to fail. And we were one of the first people to write about this, and so we know what we're talking about when we say these things. But the point of it being is credit crises take a while to work out. It's like the famous cockroach thing, which Jamie Dimon used, which is if you see one or two cockroaches, usually there's a bunch more. And we're seeing all of a sudden there was one, a month or two back, and then there's 2 or 3 the other day, and then last night you turn on the light in the kitchen and 3 or 4 cockroaches, and they're like, oh my God, what's going on? This is the situation in the private equity market. So it is affecting credit. It's going to slow down the economy. We're just bringing this up because there's so much talk of the war that underneath it, I want you to understand there's other much bigger. There's not much bigger, but there's big issues, and we have some real interesting things to be discussing on the war here in the next segment as well. But there's other things happening in the world. At the same time, and it's frustrating because we've been very bullish. Our outlook for the beginning of the year was we're going to have a good year for the economy this year. We said, look, there's going to be some turbulence at the beginning of the year, and then the economy was there's so many factories going in, and we figured there's $500 billion worth of $1 trillion worth of factories coming in. When we said our number is low, other people are using $1 trillion, and I think the number is probably between $500 and $1 trillion of factories coming in. They were being permitted last year. They're starting to build this year. We've got additional. We've got tax refunds coming up that are going to be bigger. Things are going well. Oil prices are cheap. Things are. We're going to have a really good. We're reshoring manufacturing. President Trump came up with a brilliant plan to use tariffs to reshore manufacturing back to the U.S. Companies are agreeing to put factories back. I mean, things are going great. And since then, it's just all gone to hell. First it was the Supreme Court torpedoing the tariffs, which means in theory we have to come up with $175 billion more to pay these people back. But understand what we were set up. What we had set up was, okay, this is the situation we have. $38 trillion worth of debt. Our debt's growing at $2 trillion a year. This is going to lead to a failure in the United States. It could be skyrocketing rates or a collapse in the dollar, or worse. What are we going to do about it? So Secretary Bessent comes, well, hey, why don't we do this? Why don't we try to adopt China's plan to force factories to come back to the United States and take their factories back over here so the economy grows, we get more tax income. And we're like, well, how are we going to do that? Well, we use regulation, but if we use these tariffs, we can negotiate a lot of them back and force them back. And in addition, we can get probably $250 to $300 billion in revenue from the tariffs, so we don't have to raise taxes on Americans. And so that reduces the deficit $200 or $300 million, say $250 to $300 million. And then, in addition, since these new factories are coming in, the economy is going to grow. So if we get another 200 billion more in taxes because of a growing economy, that's $500 billion. That's great. And then people will see that the manufacturing coming back to us, they're going to have confidence in the dollar. And we're paying down our debt. Our borrowing will drop, and the Fed's going to be cutting rates 2 or 3 times. So we'll pick up another $200 billion. And so all these little things, and then we're going to cut government spending through DOGE, another $200 billion, and it's all in our deficit. It's all going to be good. And now all of a sudden we have a situation where the Supreme Court torpedoes the tariffs, which I think was the start of a real problem. Now we got to come up with $175 billion instead of reducing our deficit probably $200 or $300 billion this year. We're going to have now got to pay back a little bit more, which makes our deficit worse. Okay. In addition, we have oil prices at $100 a barrel. That's a disaster. And now, since the tariffs are gone because the Supreme Court, how are we going to get the factories back here? Some of them are going to come back, but some are going to delay it. And now with the war, the Arab countries are saying, look, we're not putting any factories back there. We got to rebuild our country. So it's all not going well real quickly. And this is a real problem. And this is kind of what we're struggling with now is how do we deal with this issue? And so things are changing. And like I said, I think it really started with with the tariffs. I mean, at least the Supreme Court could have done as well. These look like they were emergency tariffs, but they were the incorrect ones, but the tariff money stays on. And then we don't have to come up with $175 billion because we just got to pay another $100 billion for the war. So that's $275 billion, which is why interest rates, the 10-year has gone from 3.95 up to 4.28%, which is hurting us even more. So how do we deal with this? What's going to happen? We're going to discuss that after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
I'm Ted Gioka, and I approve this message.
Max Out Savings is looking at rising interest rates, the bond market, and our country's spending to project the impact on your retirement. They use that data to help you flex to current conditions with your future in mind. Call 713-627-0400 to learn more. That's 713-627-0400 or maxoutsavings.com. Remember, you can hear the Max Out Savings program right here Saturdays at 10 a.m. on AM 1070 and FM 1033. The Answer.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
If you can snap your fingers, you can find this radio station. So the next time you want to listen to us, your smartphone is now your smart radio. We're always on. This is AM 1070, The Answer.
In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome back to the Max Out Savings Show. We just kind of laid out, as we've talked about since the beginning of the year, that people really didn't understand that Trump and Secretary Bissett had a real plan to fundamentally reorder the United States economy. We're going to bring back manufacturing. We're going to get interest rates lower. And we were going to strengthen the dollar, and that was going to reduce our deficits, and it boost the economy and boost the deficit. And it's just been, I mean, they're going on and on. They just this federal judge just, the Trump administration investigating Chairman Powell of the Fed for basically overrunning the budget for refurbishing a building. I think they spent they're like $1.5 billion over budget, and what happened here? And they try to investigate, and the federal judge says, well, you can't do that because there's no evidence. And Gene Piro's like, well, what is $1 billion? Where did that money go? But it's just, the point being is that President Trump is trying to force down interest rates. We pay some of the highest rates in the world compared to other countries. And the media and the Democrats just go crazy because Trump's trying to force it. Well, we got a $39 billion deficit. So we had a plan in place for all this, but our problem now, the plan is kind of blown up to some extent. And so where do we go from here? It's not – with the war, right now, the main driver is going to be the war. And we're going to cover where this is going to affect markets here in a little bit. But the situation with the war is, look, wars typically take long. When World War II started, nobody thought it was going to be a 5-year war. People don't think Vietnam. I think that was a 10-year war. These things just go on and on and on. In a couple thoughts here, if you look at it, a couple things are happening. This thing is going worse. They're attacking the Straits of Hormuz. they're also attacking oil and gas facilities over there. And so this kind of wasn't quite was expected. I think they really thought, the Wall Street Journal has a thing that Trump really didn't think that they closed the straits. He thought they would I think they were sort of hoping that, hey, look, we're not going to do the nuclear weapons anymore. We're going to try to reform a little bit, and we're going to sit there and not go after Israel anymore. And everyone goes, okay, fine, let's just walk away. But instead, it's turned into somewhat of a death match, and that's not a good situation. It's going on, and the problem is that it's closed down two things. Everyone's concentrating on the Straits of Hormuz, and they're looking at that. So as we talked on the show last week, look, it's not just the Straits, it's how much damage is done to the oil field facilities, the loading terminals, the gas pressure train, the LNG trains, the pipeline stations, all of those things. How much damage is done to that, and that takes time to repair. And so the numbers are pretty daunting. The number of I think it's like 13 million barrels a day comes out of the Persian Gulf, and a day. And so the problem is if we're cut off, what do you do in that case? And the situation is, it's just not easy. If it goes on for like 30 days, it's like it's like 400 and something, 400 or 500 million barrels a day. About 400 million barrels a day are offline, and the problem comes in is how do you get that back? And it's not going to be easy. And so we're releasing the Strategic Petroleum Reserve, and Trump's being pretty smart about it. This is like the fourth time we've done that. I think in 05, 90, 91, 2022, and 2005. No, 2005, 2011, and 22. We did this where we sold oil from the Strategic Petroleum Reserve. Trump is saying, okay, I'm going to sit there and sell you this, but you have to give it back. So you need it right now, but if you can give it back in 6 or 9 months or a year with an additional barrels as kind of quote interest, we're all going to be happy, which is smart. So he refills the Strategic Petroleum Reserve. So that's a positive. There was about 30 billion barrels of oil, 32 million barrels of oil floating around in Russian tankers that had been sanctioned. That's more oil coming on the market. And so all of these things are kind of adding up. I think it's about 85 million barrel from the Strategic Petroleum Reserve plus 30 million from the West. So it's all helping stabilize the market, and a lot of oil's coming on the market. Now, one of the problems we're dealing with is if you look about 30 years ago, where are my numbers here? The Arabs, they had about 5 million barrels a day of refining capacity. It's up to 11.5 million barrels of refining capacity in the Persian Gulf that's shut down. Well, the problem is it's easier to find oil than it is to find refining capacity, because they're a good portion of the refining capacity in the world. And many countries are now running short of different things, everything from gasoline to diesel to LNG. 20% of the world's LNG goes through the Straits of Hormuz. And so a lot of countries are in trouble. Most of the oil and gas from the Middle East actually goes to Asia. And so they're in much worse shape. The Asian countries are in bad shape. Many of the European countries, they're going to have to reroute the LNG from Europe to try to help stabilize Asia, which is putting higher prices on ours. We're not in that bad a shape. One of the problems we're running into is ourselves and Israel started this war, and I believe it was justified, but we did it in. The rest of the world is paying a much bigger price for us. Their stock markets are actually going down worse than ours. We produce and actually export oil and gas, so it's not hurting us as much. We've got a lot of refining capacity, except for California is completely screwed because they get a lot of their oil from their refined products from Asia. And one of the big things that happened this week was that China came out and said, look, we're not exporting any refined products. So the refined products aren't coming out of the Gulf. They're not coming out of China. So this is the price of your gasoline, and it's a fancy way to say your price of your gasoline and diesel fuel aren't likely to go down. And so this is something that I think we're going to have to continue to watch closely here. But I want you to understand this is a serious problem. It is a global problem, and so that's kind of that's what we have to understand. Now, if we go back over and look at the stock markets, it's sort of been nothing to see here the whole time. The S&P 500 was down 3.3% year to date. And it really seems like, if you look at oil, if you look at West Texas crude is up about 76% off the beginning of the year, somewhere in there. Brent's up about 71%. So, I mean, the world has completely changed. We've lost our tariffs. And again, I think that's a big story. And so the question kind of comes in: what's going to happen from here? Are we going to lose to Iran? No. I mean, Iran is now saying, well, if you talk to them, they'll let your tankers go through. Well, we can't do that, because then it's basically every country's going to have to go kowtow to Iran, which puts Iran in control of the Persian Gulf, which means we lose all control over the whole Middle East. And so that clearly can't happen. And so clearly this is going to go on for longer here. And the Iranians are watching. The problem is they're watching our stock market, because President Trump and the administration has been talking about the stock market so much. And you don't base how well your economy is doing. You base it by manufacturing, production, jobs, and wealth. You don't focus on the S&P 500, and that's a big mistake. And so the Iranians are going, well, look, if we just keep pushing, their market will crack, and then they're going to be much more likely to give us a good deal. And I think that's happening. And so we've got to be very cognizant of that. But look, we're winning. The question is, how bad does it get? And if the Iranians go, hey guys, we're sorry, we give up, we're surrendering unconditionally. Look, these oil prices, these gasoline, diesel, they're going to be around for a while, because they're we're in what, 2 weeks now into this thing. And that's 14 days. That's 100 million barrels of stuff off the market, and that. The products and everything else, that doesn't include fertilizer prices jumping up over 30% as well. And so huge problems out there, and it's going to take time to work through it. So what do you do in this type of an environment? And I think you want to kind of continue to reduce risk, to put hedges on in place. It typically, almost every single time oil's going to $100 a barrel, the S&P 500 is fallen 20%. Maybe it's 19%. I mean, if you really look at this, but this time it's really been a remarkable, nothing to see here for the S&P 500, though many stocks are down. So really, we're only down about 5 or 6% off the top, the all-time high in the market, which is in a very overvalued market. And so I think there's more risk. We've been saying in the show here, we think it's going to go down to the 200-day moving average. We don't use a lot of technicals for our clients at Max Out Savings Advisors. What I find is when things start going down, sometimes if something's not working, if you look at the technicals, it'll kind of give you a heads up of what's happening. And it's a good idea to kind of, or where things could go. And this market has been holding up, and it finally started to break down this week, where people started to get a little bit concerned. But if you look at the oil and gas market, if you look at other markets, they're a lot more concerned. And what concerns me is there's been a lot of retail buying, people rushing in to take advantage of the dip, on Wall, because CNBC and these different places have been saying, oh, you got to get in, and oh wait, Trump's about to do a deal, or it's been one thing after another with that type of stuff going on. And the problem is everybody thinks there's a deal, or Iran's about to surrender tomorrow, overnight. The market runs up, and a whole bunch of people invest their money, and then it goes down, and they're all losing money. So eventually it starts becoming real corrosive, and I think we're there now. So the question is, likely we're going to bounce off the 200-day moving average, which is only about 32 S&P points. It's at 6604. But the question is, does it break through here, and do people kind of panic? And that's what we're trying to watch and trying to understand. And I think it was just a war. I would say, look, I think we're going to bottom in here somewhere pretty quick. I'm not completely convinced based on the private credit and the AI stuff. I'm going to discuss that. And again, how do you deal with this to protect your retirement in this type of market? We'll be right back after this on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
FM 103.3, The Answer.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
AM 1070, The Answer.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
A radical agenda by the far left is destroying the bedrock of this great nation. We must protect conservative ideals with our votes and in our homes. This is the sound of freedom. AM 1070 and FM 103.3, The Answer.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. We had a drop on the connection, and so I might repeat some of this stuff a little bit. But what we're saying here is we're just talking about what's happening with the war effort, and there's been a huge amount of oil and gas cut off, about 13 million barrels a day, and it's been for 2 weeks, so we're up to well over 100 million barrels. And I think this thing before we restart is going to be 200 or 300 million barrels. It's going to take time to get this. There's a shortage of refining capacity in the world, which is worse than the oil refining capacity because so much refining is done in the Middle East now. And so this is why diesel fuels jumped up and gasoline. Actually, West Texas is up 70% in the last couple weeks here. And so what we're seeing is this is affecting globally. Fertilizer prices are up. All across the globe, there's problems. And so the question is, where does this all go from here? And I don't think it's all priced into the markets yet. I think it's going to take time to get, for this thing to play out. Even if the whole thing ends tomorrow, it's going to take them at least 2 or 3 weeks just to get the production up on the Gulf, up and going again, to get the LNG running again. That's if there's no severe damage done to Qatar. And so this the markets aren't pricing this in right now, and I think you have to be a little bit more cautious overall. And the other thing is we talked about at the beginning show, this private credit situation is continuing to spread, and some banks are asking for more collateral from the private debt funds, and other things, and so this is going to slow the economy. And the other thing is the AI. AI is just incredibly exciting, but there's a lot of issues with it. And there's rumors now that Meta is going to lay off 20% of their workforce. Well, if all the tech companies switch to AI and start laying off, keep in mind Jack Dorsey's company, Square, they laid off, I think it's called Block now. They laid off over 40% of their workers. If this spreads through Silicon Valley, this could cause huge amounts of layoffs out there. And even I was listening to one of the companies at ServiceNow, and they're like, look, we're not going to be laying people off. We're going to hold our hiring flat. Well, what's going to happen is they're not going to be hiring new people. They're just going to try to keep the people they have. This could cause a slowdown in the economy. Remember, 3 weeks ago, say a month ago, we were in a world where they had tariffs coming up. We were getting tariff money coming in, and so since there were tariffs in place, companies were rushing to put factories back into the United States. We had defense factories going full blast. We had AI built out. Everything was great. We had more income coming in from the tariffs. We had more income coming in from economic growth. We had lower interest rates because we were going to be reducing our deficits. That's all changed. And so the problem is that now the world has changed, and this AI, which was looking really great, and they're doing all this build out. Hey, this is fantastic. All of a sudden, these huge layoffs are rippling through the industry. I mean, if you're with Microsoft, Meta, Google, Amazon, all these people, they're all worried about their jobs now. And so these are big issues that haven't been worked through. 6 months ago, when everything was really going great, I mean, not even, but 4 months ago, if you look at it, everything was great. The markets were booming. They'd been up for 2 years in a row. Things were fantastic. But since then, people are seeing some of these negatives are all popping up, and so the market's had a huge run up. So I do think you have to be cautious. We continue to have our hedges on for our clients, and we're really trying to spread the risk. We have a high level of cash as well, and I think it's not of like, oh my God, let's liquidate everything, but it's a matter of, hey, what do I do in this situation? Do I want to have some cash on the sidelines? Because if you have cash on the side, we've actually bought something here the other day in the fertilizer sector, just a small position, and so it's like our next door neighbor here coming up into the country seems to have got a new AR or something, but I'm sorry about that. But you want to have the cash to be able to make some changes. And so if you're thinking of buying, if you're thinking of selling, it's never a matter of 100%. This is one of the things we talked about on the show from time to time. If you make it a black and white issue, that's a very difficult decision to make. What if I'm wrong? But if you move in steps, it's much easier to make decisions because they're not such high pressure decisions. So something to think about when you're trying to look. I mean, like if you're trying to decide, do I buy, do I sell, or whatever, make the decisions incrementally, and it'll be much easier. One thing about the private equity, one thing I was thinking about, and I want to talk about this in the show today, was the private equity guys, in a way, complaining about people wanting to all leave because this is supposed to be locked up money. Look, we've sold out some stuff here recently we've had for a long time. We've had huge capital gains on it. Some of the things for our clients, when we bought them, they didn't work out right away and they kind of went down, but we held on to them until you analyze stuff. But if you're a wealthy person, you shouldn't be buying and selling your whole portfolios. You want to put in investments for the long term. They're going to grow your money to a huge amount, so you can make big returns. That's how people get wealthy. They rarely get wealthy trading. They'll trade a little bit back, but the big money tends to be made with holding on to something, being in Exxon or in Nvidia. We don't have any Nvidia, but there's numerous other stocks out there that you can get the 100%, 200, 300, 400, 500% returns on, because that's how you make the big money. So this is, oftentimes, if you drive through like a River Oaks or Tangle, every once in a while you'll see a lot. And you go, my God, why would someone leave a lot there sitting there? These people have a lot of money. They know the lot's going to go up in value over the long term, and they just sit on the lot, and they're diversified into different asset classes, and they're not panicking out of every, trying to run a trading portfolio to maximize, their gains for the quarter. That you've got to think long term. So that's one thing to think about. My concern, to some extent, is everyone has kind of drank the S&P 500 Kool-Aid now, and they just have a whole lot less risk than you would think. I mean, they have a whole lot more risk because they're unwilling to sit there doing any risk management because they're in it for the long term. So those are just a few things to think about in here going forward. And one other thing I wanted to touch on is at Max Out Savings Advisors, we manage retirement money. We manage old 401ks. People retired, they come to us, or they have a trust, that type of thing. When it comes, and we don't, long-time listeners of the show know I don't always want to try to sell stuff, but that's sort of our business. But at the same time, when it comes to 401ks, and we pretty much, when someone comes in, it's, well, what would you like us to manage? And we're just not going to sit there be calling you constantly to give us all your, it's what do you want us to manage? We'll handle it for you. How can we help you? Let's take a look at everything. But when it comes to 401ks, I really have kind of shifted on this to some extent. Once you leave a company, you're gone, and they really understand that it's not like the old days where someone at the company is still running it, and even if you had a problem, you can call up, Bob back at the company, and you can say and he'll know someone in HR, and they'll get your matter taken care of. Most of these big companies have farmed this out to the big players in the business, and so they don't have. So they're just kind of running it. They don't really have a fiduciary duty to you. They have a fiduciary to them in the firm. So they're not. If you work with us at Max Out Savings Advisors, or most advisors, we have a fiduciary duty to you. That's our number one responsibility is to you, not to the firm. They don't have that fiduciary duty at these 401k places. Once you've left, and it's worse than that. If anything happens to you, these things become a mess to get out of there. It's a lot of work. We've dealt with a number of them. I'm shocked. We've had one of them that we're sending out. The person passed away. The wife was dealing with it, and they were sending out 20% because they couldn't of the thing a year, which was way off what it should have been. They didn't call up. They didn't call the wife up, tell her anything. They took no. They had no withholding, zero withholding out of the account. We finally worked with the client, called up the company. It's Fidelity, quite frankly, and we said, look, we're really concerned about the withholding. You guys didn't do that, and then we went 30% out this time just to be on the safe side. They took out 3%, and then one of the 20% checks was lost in the confusion, and we asked if there was anything that came out, and they said no. We had them call them back again. They finally said yes. It was a year and a half later, and they never called the client up and told them it was a very sizable check was lost. They didn't even care. And we've come up with numerous times with clients, particularly when they get older, they tend to keep it there because they like the company. These people do not care about you, and we've been surprised on how there's no know your client rule or anything at all with these 401k people. And so understand if you leave it, you after a couple of years, you should probably get your funds out of there, get them managed somewhere, or consolidate or do something, because it's a real issue. And we really surprisingly with sometimes we transfer from other areas. We transfer into it, max out savings, but we don't really have problems. And oftentimes if a person's leaving the company, as they're leaving or retiring, there tends not to be problems. The problems come in if it's been there for a while. That's when there seems to be real problems. So my advice to you, if you have an old 401k plan, to get it out of the companies, because they're not going to do you any favors, and the possibility of mistakes based on our experience is pretty large. And I've been really shocked at how bad some of the service has been. So that's a couple things. Back to the Iran war. This is going to take time, and it's just the question is how soon can they get that oil up, and how much damage is done, as we've talked about. And one of the things, there's a lot of censorship. So I just saw a story that some British person is looking at jail time in Dubai for, I believe it was Dubai, for taking pictures of a missile hit. So we're not seeing the damage. It's not that we're so thrilled to see the damage, but we want to understand, look, how much damage is done to this oil infrastructure. What are we looking at long term? It's very hard for it to do. In fairness to them, because they don't want to give the enemy any idea of what's being blown up so they can see how good their targeting is, even though, quite frankly, with satellites, everybody knows what's going on. But so understand this is a very complex and it's a very fluid issue. I've seen different ways that maybe we should go put troops in on the western plains of Iran and just cut off the rest of the country. That's where the oil is, and just seal off the rest of the mountain areas. I mean, I don't know what they're going to do, but one of the things is all this stuff about, hey, we're about to get this solved tomorrow, Trump's going to taco tomorrow and stuff, isn't doing anybody any good, because the Iranians are looking at that and going, well, look, they're about to cave at any minute. Their market could go down, so we need to just hold out. It would really be better if people in Trump started to do this. Look, hey, we're in it for the long term, whatever it takes. Then ultimately they back down, and it's frustrating that the media is constantly coming up with this. And part of it, candidly, are really big institutions that are trying to unload big blocks of stock. If they can float a rumor on Wall Street and get a bunch of retail investors or hedge funds to cover their shorts, or retail investors to buy, they can unload their blocks of stock. Because if you're a big, $500 million, if you're $100 million, $100 billion operation, you can't just go unload stocks. I mean, when we're trying to just buy or sell stocks, some of these thinner stocks, we're not real huge or anything. We've got to use special trading programs to get it done, and we're not that big, these big guys. So if you can float a rumor, you can get a whole lot of stock sold based on people either short covering or retail investors coming in. And so understand there's a lot of games being played on Wall Street now, and so now is not kind of the time to be the hero. Again, the bitter areas, what we've been telling you, shorter term bonds. Bond rates are going up right now until we kind of understand what's going to happen. Are we going to have more inflation? We've seen the 10-year, as we said, starting to jump up. It's up nearly probably maybe 0.4, but 8.5% since this thing happened. So shorter term bonds, very high quality corporate bonds. I mean, I think one of the things out there that's most misunderstood is high quality corporate bonds really have good liquidity. In an absolute complete collapse are probably going to outperform government bonds, and so but you're getting paid more, and so that's just we do a lot of deep dive work into what if this, what if that, what if this, because oftentimes we find the money is made when things go wrong. If you're ahead of that game, you're way ahead of everybody else. So shorter term bonds, I think higher levels of cash. We like stable demand in here. We like oil and gas. We've been kind of pulling some off the table. We've liked the gold and the silver. We've been pulling some off the table there too. It's kind of difficult. I think if this market starts going down, they're going to hit everything, including the precious metals. So something to kind of keep in mind in here. I think stable demand. There's been an enormous amount of money coming out of high tech, which we've talked about, the big mega cap $1 trillion valuations. And one of the things to keep in mind is that those the money is so big that it's going into a lot of other stocks and running them up. Just as an example stock, Caterpillar has gone from, really, when they started selling out, it's gone from about $500 up to hit $800 here since about October of last year. It's come down. So, well, that's money getting out of NVIDIA and getting out of Google and those type of stocks. And what do I buy? And they're going in, but your Caterpillar market cap, I don't know what it is, probably 100, maybe 200 billion. These big Apple's at $5 billion. So just if you look at that's what's happening. So this big money has been cascading into these other areas, and the question is have they pushed up some of those other areas too high? And I think they have to some extent. So again, I think caution is in the air, and I think you want to continue to rotate the value. Value is in these type of markets. That's where you got to go is into value, because they're getting out of the overvalued stock, buying the cheaper valued stock. And even if things don't work out for the better, your value is going to be the better deal in this environment. So I think that's the strategy. A couple thoughts. Okay. If you haven't signed up for our free Max Out Savings Report, I'm going to try to get one out sometime this week, writing about all these big issues. It's a free report. It's called the Max Out Savings Report. We've been doing it for over 20 years now, and really caught some of the biggest things. We've been all over a lot of these big news ahead of most other people out there, quite frankly, including most of what you're reading in the media. We try to get you ahead of time. Plus, we have savings ideas, ways to increase your savings, build up wealth. It's all in the Max Out Savings Report, completely free. You're not signing up to get phone calls from us or emails except for that report. Just go to maxoutsavings.com. It's maxoutsavings.com. In addition, if you need some help managing your retirement funds, or like I said, have an old 401k, we manage money using a conservative value approach at Max Out Savings Advisors. We'll be happy to help you. Our real specialty is when things get bad, we tend to do very, very well at dealing with big issues. So if you need some help, go to the website, maxoutsavings.com. You can sign up for the newsletter there. Also, get our phone number, email, and just drop me an email or a phone call, and you can request an appointment. We'll sit down with you here in Houston, Texas. This is where our headquarters is, and show you how we manage money. So I'd like to help you out if you need the help. But anyway, and so remember our motto in philosophy, which is to save aggressively and invest conservatively. Save aggressively, invest conservatively. That, my friends, is the key to building up the wealth. Remember, this is the United States of America. We always come out ahead, but sometimes it gets a little bumpy along the way. But in the end, we're always coming out ahead. We'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.
AM 1070. The Answer.